Welcome back to another Market Insight call. Aaron is out this week. Filling in for him is Christina Shockley, our Chief Planning Officer. Thank you for doing this.
Thanks for having me.
Before we get into it, I did want to call attention to our call next month. It's going to be a fun one. We got Steve Cheveron. He runs research at Federated Hermes, a $750 billion asset manager. He's going to help us talk through politics. We're going to talk a little bit about how you should invest during an election season and give us a help with a second half of the year forecast. So let's get into our outline. We're going to start with a chart on the S&P 500. We're going to look at the concentration that's come from the index and look at what impacts that could have. We'll turn it over to Christina for her top 5 tax tips to close out the second half of the year. We'll have a quick inflation update, look at what the Fed did last week as well, and we will close with some concerning behavior in the market. And we found a story that we have to show on the planning side that was a bit concerning too. It was too good to pass up. But let's start with our S&P 500 chart. We have a great uptrend from October of last year where the market went from 4,100 to 5,500, about a 34% return. And a lot of this is the narrative of the market, which has been disinflation, earnings, AI, and productivity growth. So starting with just disinflation, the last few reports on inflation through PCE and CPI have been supportive of markets. Markets have liked them a lot. Earnings growth, well, we closed out last quarter's earnings with 78% beat rate. It was above the historical trend and more than the market was expecting. That's been supportive. And when the market started to have a little bit of a pullback, we had a good timing in the market. We had NVIDIA and Broadcom, some of the AI and productivity names through the build out of data centers, and they had really strong earnings and good forecasts, which led to a recovery in the market. So it really gets us to a question, which is the market moving a little too fast? And when we talk about it internally, it is probably overbought, and probably the market is set for a breather at least. A simple measure that we've used on this is the RSI. Just a look of overbought or oversold, and generally those numbers we use are 70 and 30. It's not important how they're calculated, but looking back historically, we can look last April, we saw a breach on the bottom left of the chart here where we had over 70. Well, that actually led to it did lead to a full correction, but in the short term it was a 6% pullback that we show there. So that can happen when the market moves a little bit too much. There was some geopolitics that came in later in the month of October. But we can look later. There were other breaches above 70. And it doesn't have to be a strong pullback. It can just be, like I referenced, a breather in the market where it's a 1-2%, just stopping that rate of change where the market's moving up a little too fast. Something we'll talk about later with some of the changes that we made in portfolios. They were small changes. But we know what's been working and driving the market is concentration. I made this slide several months ago. We've had to update it a lot because there's been a lot of changes to the concentration in the index. When we first made this slide, and it's called why private equity, it could be just called why diversification, why diversifying away from the highly concentrated S&P 500. We started the year with the top 3 stocks at 17% of the index, the top 10 at 32% of the index. We had several changes over the coming months, and we actually had changes in the top 3 stocks, where NVIDIA took over the 3rd place for Amazon. And now the index is weighted at 21% in the top 3 stocks, 37% top 10. So we have a lot of concentration in the S&P 500. Of course, that gets us to the question, is it too much? Is it a bad thing? And when we look at the data, we think it's one of those things where the data can show you can play with the numbers however you want to show your case. There are periods like 2000 where concentration was high, similar to how it is now. And we know the market pulled back significantly in 2000. But if you would have tried to pull this, and we would have talked, I'm sure in our calls, if we would have clipped saying concentration is concerning at the beginning of the year, well, we know what 6-month forward returns were at the beginning of the year. To today, they've been pretty strong. So it's not necessarily a bad thing, but overall, in the long term, we do want to see a little more participation in markets. When we started the year, our plan was always, we thought the name of our presentation to start the year was called Status Quo. Large cap would continue to perform. And that's what has happened. We do think that they're going to broaden out at some point. So the plan has always been, these are great businesses, but we do want to keep looking to diversify away from them. Also, when we say only a handful of stocks are performing well, it means a handful of stocks are not performing well, and that's giving opportunities to tax loss harvest. So the plan is continue to harvest those losses. It's going to allow us to take some gains later in the year to offset those. And of course, speaking of tax, we want to turn this over to Christina for her top 5 tax picks for the end of the year.
Welcome everyone. Today we'll discuss 5 tax tips to help optimize your finances in the second half of 2024. At GWS, our client care teams are gearing up for the second half of the year, which typically includes bringing tax-efficient ideas to our clients. These strategies are essential for maximizing your wealth and minimizing your tax. Today, we're going to review the top 5 tax tips for 2024. Taking advantage of tax loss harvesting, as Chris just mentioned, maximizing retirement plan contributions, utilizing tax bracket management, avoiding the Social Security tax torpedo, and being aware of potential tax law changes. First, we're going to go through tax loss harvesting. Tax loss harvesting involves selling investments that have declined in value to offset gains and from other investments. This strategy helps reduce your overall taxable income. These capital losses can offset capital gains dollar for dollar. What's great is that it doesn't have to be a gain from a portfolio that you generated the loss from. It can be a gain from a real estate property or even another investment portfolio that you manage personally. Plus, if your losses exceed your gains, you can use up to $3,000 of the excess loss to offset ordinary income. Typically, ordinary income rates are higher than capital gain rates, so that's extremely beneficial. On the portfolio management side, strategically selling underperforming investments and carefully selecting replacement assets, you can maintain a portfolio's desired asset allocation while optimizing your tax situation. For tax topic number 2, maximize your retirement contributions. Most years, the IRS increases the amount to be adjusted by inflation that you can contribute to retirement plans. This can be tricky for many employees who have contributions on autopilot. As we enter into the second half of the year, make sure you are set out to maximize your retirement plan contributions before December 31st, as it is extremely beneficial from a tax perspective. For traditional and Roth IRAs, you are able to contribute $7,000, plus, if you're over the age of 50, an additional $1,000. For 401k plans, you can contribute up to $23,000 with an additional $7,500 if you are over the age of 50. For dual income families that both spouses are covered by a 401k plan, this means that you could contribute up to $61,000. If you have unequal incomes, keep in mind that many employers allow you to contribute up to 90 to 100% of your income. For those who are 1099, sole proprietors, single-member LLCs, or businesses that don't have employees, a SEP IRA plan may be for you. If you have not already looked into it, this type of plan is for those that are self-employed. It offers a contribution limit of up to 25% of your income, up to $69,000 for 2024. This is a great option for maximizing your retirement tax savings. For tax topic number 3, we have utilizing tax bracket management. For many of our retirees, we look to optimize their tax bracket to reduce taxes. Let's take an example of John and Jane, who live on $120,000 per year. You might assume that in order to generate that income, they would have to pay a significant amount of tax. However, you pull the income from the portfolio makes a huge difference. John and Jane have IRAs, which are in the tax-deferred bucket, and taxable accounts, which are taxed at the capital gains tax rate. Let's assume that for the 2024 tax year, we decide to distribute $30,000 from their IRA and $90,000 from their taxable accounts. Their taxable account has a gain of 75%, therefore they're going to generate $67,500 of capital gains for 2024. While they received $120,000 of funds, their total income would show $97,500 on a tax return. The standard deduction is $32,300, which would make their taxable income $65,200. Remember that taxable income is calculated as their adjusted gross income minus deductions, either itemized or the standard deduction. In addition, there are different tax brackets for capital gains compared to ordinary income. If John and Jane can keep their income under a certain threshold, they may pay 0 tax on their capital gains and have a 0 total federal tax owed. This approach emphasizes the importance of understanding how different income streams and deductions affect your overall tax liability. Notice that in this example, we did not include Social Security income, which will bring me to my next tax tip. Tax topic number 4 is to try to avoid the Social Security tax torpedo. Social Security is actually taxed more efficiently than earned income, as only up to 85% of the Social Security income is taxed. However, it is important to not only manage your income tax brackets, but also the provisional income tax brackets that include Social Security. A tax torpedo is the sharp rise and the sharp fall of marginal tax rate as your income increases. This tax torpedo occurs when other income or distributions impact your provisional income. Your provisional income determines how much of your Social Security income is taxed. Only half of your Social Security income is included in provisional income. Any Roth IRA distributions are not included in provisional income. As your income rises, it pulls more of your Social Security into that taxable income, creating a higher effective tax rate. This means that every dollar of income can have a double impact: taxation of the additional dollar and taxation of another portion of your Social Security benefit. However, once you surpass that threshold, the double impact stops. Be aware of the tax torpedo to avoid offsetting your tax planning efforts. Lastly, tax tip number 5. Be aware of the potential tax law changes that are coming in 2026. Tax deductions and rates are set to revert back to what they were in 2017, adjusted for inflation, in 2026. So what type of planning should you be doing? Well, if you look at this slide, nearly every tax bracket increases. Therefore, you are likely to be paying more tax in 2 years for the same amount of income. If you look, the 12% tax bracket moves to the 15, the 22 moves to the 25, the 24 moves to 28, the 32 moves to 33, and the 37 moves to 39.6. Let's look at an example using our tax planning software. Here we are showing an income projection for the tax year 2024 versus 2026 using current law, which shows that the scheduled increases come into play. As you can see, we show the same exact amount of income earned in these 2 years, the same amount of IRA distributions, the same Social Security income, and the same capital gains. That gets us to a total of $280,500 of total income. The only difference is the year and the tax law, which is in effect. The first difference is that the standard deduction has reduced and exemptions have increased for 2026. This change alone already increases the taxable income amount. Then, by the marginal tax bracket changing to 25% instead of 22%, it increases the total tax by $3,323. Plus, any additional $1,000 of ordinary income would have a 3% tax increase, compounding the tax increase as the income rises. A strategy that can be implemented is to do Roth conversions now to fill up that 22 or 24% tax bracket to pay a lower effective rate than what is projected in 2026. Thank you for joining today. Implementing these strategies can help you optimize your financial situation and reduce your tax liability. If you have any questions, please feel free to reach out. gws@gatewoodwealth.com.
We said we were going to close with inflation and a look at what the Fed had to say most recently. And when we look at this CPI report, now the Fed prefers to use PCE for their 2% target. We can see that on the right-hand, top right of this graph, we have the estimates, which is where we thought, where the consensus of analysts thought the estimates were going to show up for this report. And on the left, we have the actual. And across the board, the actuals came in 10 basis points below what was forecasted. Really good signs. I think the market would have been happy with just the estimate coming in, which would have been no change. If we're looking at the year-over-year numbers, the 3.5, 3.4, month-over-month, that would have been pretty similar. When we look at the bottom of our graph where we have the Fed fund rates in pink and then in blue and light blue are the two measures of CPI, they're trending downward. That's what we want to keep seeing. It's been supportive of markets. Markets have probably priced it in a little bit too quickly, moving too fast like we spoke again earlier. Then we can look at what the Fed said at their meeting. It was a projection meeting, the SEP, Summary of Economic Projections, which is just looking at median estimates from every member. We can look at what they said from PCE, which they upgraded PCE, meaning they think inflation is going to be in hotter than the last time they reported on this. But that was widely expected. We had a couple higher PCE reports at the beginning of the year. This was well telegraphed. The market handled this really well, and that's at 2.6 on what they expect for this year. It was right in line with our expectations beforehand, before this started. The strange thing that happened was they did not downgrade the economy through unemployment. They came in at 4% expected unemployment by the end of the year, which was the same as what they projected in March. The only difference is since March, we have actually seen unemployment tick up to 4%. So we're already there. So the most recent report showed an uptick. They're saying we're going to hang out here. I think most people don't think that's going to happen. We're going to see a couple ticks higher on unemployment. It was pretty funny in the press conference. Powell had a really hard time answering that question just because that projection really didn't make sense. But the final one at the bottom right, that's what the market really wanted to hear. What are they going to do with interest rates? And the average, the median expectation is 1 to 2 rate cuts. And really, to paraphrase what Powell had said and the projections, what they show, is there are only 1 or 2 rate cuts this year, maybe 1. Doesn't think it's really going to do much. He really made light of how little 25 basis point cut would actually do. But he said, basically was telling the markets, hey, relax, we do still think that there's going to be rate cuts next year. And that's what shows in their projection, where they're projecting out for 2025. Rates are pretty similar to what they had already projected in March. So the market really liked this, like I said, a strong rally. Did want to close with a couple concerning things we're seeing in the market. So one of those is around stock splits. Now, we're not making large changes because of a concerning metric we're seeing in stock splits, but companies have been splitting their stock, which is just creating new shares to reduce your overall stock price. Now, it's something, if I were making that decision for NVIDIA or Broadcom model positions we own, I would have split the stock. It made a lot of sense to do it. However, as an analyst coming on TV and talking about how stock splits are changing and actually are beneficial to the company and all this stuff for fundamental reasons, it changes nothing. And it's kind of concerning to hear a bunch of analysts come on TV and continue to say, well, this stock's going to split and that's a good thing. The data are pretty clear. Stock splits are a good sign. You split your stock because the stock has rallied up. But after the stock split has happened, there really is no forward projection of saying this is going to outperform because of a stock split that happened in the past. And we're just seeing a lot of headlines, a lot of analysts on TV talking about it. It's just a sign of possible euphoria in the markets. And when we look at some of the things we talked about today and some things we don't have time to really discuss, we wanted to reduce some equity exposure. Very slight. Part of the reason equities have just rallied so much. We have equity drift, we have sector drift. So in a few strategies, we did reduce some of the cyclicality, added a couple utilities. And another strategy, we reduced equity and added aggressive fixed income, which we were calling it internally a bullish rebalance, because any rebalance is selling equities and buying fixed income. Of course, there's a nature of, you think you're selling a little bit higher, but we bought aggressive fixed income, something that should, if the market drifts up, still perform well. If the market does drift down, which we do think, or drift and stay pretty steady, we think that the fixed income can outperform a little bit. So those are some of the changes we were making in strategies. And I did just want to throw up this slide. It's something we've shown in the past. It's been a while, though. There's several different versions of these online. There's always a reason to sell, and they can sound scary. It's not what I'm saying here. This is a risk management decision to do small, few percentage points rebalancing. Of course, there's always reasons to sell, and there's slides showing that most of them have always been wrong. So we're not making a big change or saying this time's different. We're selling. It really just is a rebalance within portfolios. Those were some of the concerning things we're seeing in the equity market. Christina, I know you had a story you wanted to share.
Chris, this was an interesting article and one that reinforces the saying that you learn or get something from every relationship that you have. In this case, it was $1 million. The individual in this situation put his girlfriend at the time as his beneficiary of his 401k in 1987. They were together for 2 years and then broke up in 1989. Little did she know that just last year, she found out she was a beneficiary on his 401k that had surpassed $1 million. They broke up 35 years ago, and she just inherited the account. It is a great reminder that assets pass by 3 ways: by beneficiary designation, by title, or by law. Typically, by law, so a will, is by the last resort. In this case, the court found that the beneficiary designation was in good order and the ex-girlfriend, 35 years prior, gets the money instead of the deceased family. It is a good thing that our team helps to review the asset and beneficiary titling when we review our financial plans, Chris.
Well, that's everything we had. Go ahead and hit that like button, especially if you preferred Christina on instead of Aaron, and go ahead and share it with somebody that you think would find it useful.